Okay, let's talk about treasury stock. So what is treasury stock? Treasury stock is stock that you have previously issued and you're going to buy back. So let's say you're Apple Corporation and you've issued shares of stock and then you decide that you want to buy back your own company stock. If you do, you're going to call that treasury stock, and this is how you're going to account for it. But first, let's talk about why would we do that. So one reason would be is if we wanted to buy some and then resell it to employees, or even issue it to employees as a bonus. Say we have a stock option plan and we give shares of our own stock to our employees. That gives them a bonus or an incentive to work harder, because the better their company does, the better they are personally, because their own shares of stock that they own in their own company will increase in value as they do better. So it gives them an incentive to work harder for their own company. The third reason is that it supports the market price of the stock. So you know about supply and demand, and if nobody's buying your stock, the price drops. If everybody's buying your stock, the price goes up. So let's say you want to support the price of your stock. If you go out there and buy it, that makes more of a demand, which makes the stock price go up. So those are some of the reasons that you may choose to buy your own company's stock, and we call that stock treasury stock. So that's why I've put a picture here that says we're buying. Alright, so let's look. On April 1, Laura Corp reacquired 3,200 shares of its common stock at $42 per share. So it's worded like this so that you'll know that we are buying our own company stock. Alright, if we're buying something, then that tells us that our cash has to go down because we're using cash to buy it. And since we're buying our own company stock, we're going to call that stock treasury stock. We're buying 3,200 shares and we're paying $42 per share. So we'll multiply 3,200 times 42, and that's how much money we're going to have to pay to buy that. Now, on May the 22nd, Laura sold 2,000 of the reacquired shares at $47 per share. So here's how we're going to do this. If we sold something, then that means that we got cash. Alright, how much cash do we get? Well, we sold 2,000 at $47. So our cash that we sold is going to be 2,000 shares times $47. What do we sell? Well, we sold our treasury stock, so we need to reduce that. Earlier we debited it to make it go up, so now we're going to credit it to make it go up, down. But let's talk about what price we got to sell it at. We can only ever record it at the original price that we bought it for. So we need to look up here. What do we buy it for? $42 a share. So here, when we go to resell it, we can only put it down at 2,000 shares times the $42. Where does the rest go? Well, we have an account called Paid in Capital Treasury Stock, and that's where the rest will go. So the rest would be $10,000, which is just the amount that we received over the original price that we paid for that treasury stock. Okay, on the last part, on July 1, Laura sold the remaining shares at $40 per share. Let's journalize these transactions. So we sold, which means I got cash. How much cash did I get? Well, I sold, how many more did I sell? I originally had 3,200 shares. Then I sold 2,000, so I've got 1,200 left to go. So I have 1,200 shares, and it tells me that I sold the rest at $40. Let me reduce my treasury stock for the amount that I've sold back now, which is going to be the 1,200 shares at the original price. So I go back to this $42 number. And then the rest of it is going to be paid in capital treasury stock. But this time, I sold it for $40, but I originally paid $42. So I'm going to need that entry to be a debit to balance. So it should be $2,400. I'll make sure that my debits equal $50,400 and my credits equal $50,400, and this will be called Paid in Capital Treasury Stock. Okay, so just to get a quick look of what this would look like inside of a T account, I'll start with treasury stock of $134,400. And then I subtract out the $84,000 that I sold on May 22nd, and I subtract out the $50,400 I did on July 1, and I come down to $0 because I've sold back all my treasury stock. I don't have any anymore. So what I do still have from these is the paid-in capital treasury stock, because I started off with $10,000 here, and then I reduced it by $2,400 here, so I'm left with $7,600. So it's important to understand what this account means. This account is not a gain, it's not income, it's nothing more than extra money that I received for selling this for more than what I originally paid. And so it's going to come in as paid-in capital, additional paid-in capital. So that's how you're going to see this. Treasury stock is subtracted out in stockholders' equity. Your paid-in capital would be listed right underneath your paid-in capital in excess of par, and it would add to your paid-in capital account. So a lot of tricky test questions like to say, is this a gain? No, it's not a gain. It's just additional paid-in capital that you got from buying and selling your own company's treasury stock. So let me know if you have any questions.